Welcome to the Explainer. Okay, today we are looking at the literal mechanical heart of modern business, inventory management. For decades, tracking stock has been this clunky, completely manual gear in the corporate machine. But as we barrel toward 2026, we are witnessing a massive, precision-based shift. The old cogs of manual counting are literally being ripped out and replaced by hardwired algorithmic systems driven by artificial intelligence and some extremely strict new regulatory rules. It's a complete rewrite of the blueprint, and today we're going to unpack exactly what this means for the future of your business.
Here's our blueprint for today. We'll quickly cover the annual inventory dilemma, stricter global and local rules, cycle counting versus annual audits, tech-enabled remote auditing, the AI revolution, and finally wrap up with some strategies for 2026. Let's dive right in.
Section 1. The Annual Inventory Dilemma.
So I want to ask you a direct question right off the bat. Is inventory day obsolete? Traditionally, businesses treat the annual inventory count as this necessary evil, right? Operations completely freeze. The warehouse turns into a chaotic maze of counting sheets, and everything basically grinds to a halt until the numbers finally make sense. It's a massive drain on time, resources, and productivity. But honestly, worse than the disruption is the actual output.
Well, when you look at the reality of these manual, disruptive counts, the results they're truly shocking. Manual inventory systems typically only achieve an accuracy rate of 60 to 65%. Think about that. You stop your entire operation, you lose days of productivity, and your data is still almost 40% wrong. This is the critical flaw in the old system. And as we're about to see, operating with a 60% accuracy rate, it's no longer just bad business, it's becoming legally unacceptable.
Which brings us to Section 2, stricter global and local rules. Because of those terrible error rates, the regulatory pressure on inventory data pipelines is escalating rapidly all over the world. We're seeing a major regulatory convergence happening right now. Global reporting frameworks like the International Financial Reporting Standards, or IFRS, are perfectly aligning with local mandates like Pakistan's Companies Act of 2017 overseen by the SECP. Whether you're looking at international accounting boards or local tax authorities, the mandate is absolutely the same. They're demanding real-time transparency and absolute precision in how you value and report your physical assets. No exceptions.
And guys, there's a hard deadline approaching. By Q3 2026, public companies are going to face enhanced SEC inventory disclosure protocols. Simultaneously, local tax authorities, like the Federal Board of Revenue in Pakistan, are pushing hard for continuous digital e-invoicing. So, when digital invoices automatically sync with tax portals, every single sale instantly impacts your reported stock levels. You can't just wait until December to fix your numbers anymore. These incoming rules force businesses to maintain flawless, real-time audit trails all year round.
Section 3. Cycle counting versus annual audits.
So how do businesses actually adapt to these strict new data pipelines? Well, let's contrast the two core philosophies. Annual inventory is all about reactive correction. It's designed to figure out what went wrong over the past 12 months, at the cost of massive operational disruption. Cycle counting, on the other hand, is about proactive prevention and fluidity. It distributes your inventory checks throughout the entire year. You count a sample of goods, or maybe a specific location, without ever stopping operations. It literally turns inventory from a painful compliance task into a frictionless, continuous improvement tool.
Now, what's really interesting is that the practical reality of these methods shows there's no single magic bullet. A full physical count is thorough, sure, but highly disruptive. Cycle counting gives you agility, but requires intense discipline. The absolute best approach for 2026 is a hybrid model. You use technology-assisted cycle counting to maintain daily operational agility, supported by targeted sample checks for high-value items, to ensure you hit those strict legal compliance standards without breaking a sweat.
Section 4. Tech-enabled remote auditing.
Because counting the stock yourself is really only half the battle. Your auditors actually need to verify it. Technology is now physically bridging the gap between ongoing operations and rigorous audits. The challenge comes from rules like the International Standard on Auditing, ISA 501. It mandates that auditors must physically attend inventory counting to observe and perform test counts unless it's quote-unquote impracticable. Historically, this meant flying auditors out to warehouses and halting production just so they could climb ladders with clipboards. But in today's fast-paced, high-volume operations, shutting down for an external audit is increasingly becoming exactly that, impractical.
To solve this bottleneck, auditors are deploying incredibly advanced solutions. We're talking high-definition video walkthroughs, and even unmanned drones flying through facilities to do aerial stock takes and map large-scale assets. Plus, when physical attendance truly isn't possible, auditors are relying on roll-forward data pipelines. This means they rigorously test the digital records of recent intervening transactions to mathematically prove that physical inventory exists, without ever stepping foot inside the building. It's brilliant.
Section 5. The AI Inventory Revolution. This is where the full algorithmic automation of stock management comes to life. And the crucial point here is this: by 2026, over 75% of enterprise organizations will be hardwired into AI-powered inventory solutions. 75%. Artificial intelligence is transitioning from a futuristic buzzword into the absolute foundational backbone of asset management. Those 25% still relying on traditional manual clipboards, they're simply going to be left behind, unable to keep up with the speed and accuracy the market and the regulators now demand.
A prime example of this revolution is computer vision. We are talking about advanced cameras and image recognition systems that literally watch your warehouse. They automatically identify, count, and verify physical items in real time with zero human intervention. When you seamlessly pair computer vision with RFID tag systems, businesses are pushing that dismal 60% manual accuracy rate up to a staggering 99%. It is flawless continuous verification.
But you know what's crazy? AI doesn't just passively count what's sitting on a shelf. It actively predicts the future. Machine learning algorithms process massive amounts of historical data, seasonal trends, and external market factors to optimize your future inventory pipelines. By processing these variables, these systems can reduce demand forecasting errors by up to 50%. This directly prevents the massive capital drain of overstocking, while simultaneously making absolutely sure you never run out of the products your customers actually want to buy.
Section 6. Strategies for 2026 Success.
We've covered the problems, the rules, and the tech. So how do you actually implement these mechanical and digital upgrades? Here's a practical roadmap. Step 1. Assess your current capabilities to find the gaps in your AI and compliance readiness. Step 2. Develop a phased integration strategy. You definitely don't want to break your existing operations while upgrading. Step 3. Invest heavily in training your people, because a new tool is basically useless if your team can't wield it. Step 4. Establish a tight governance framework so the AI's data actually satisfies the auditors. And finally, Step 5. Continuously monitor and optimize the system.
I want to leave you with this final, truly provocative thought. Look at your own warehouse operations today and ask yourself, is your inventory currently a compliance risk just waiting to trigger an audit? Or is it a fully optimized, strategic asset driving your business forward? The blueprint for 2026 is written in AI, real-time data pipelines, and strict regulatory adherence. The time to modernize your own systems isn't next year, it's right now. Thanks so much for joining me on this explainer, and I hope this sparks the exact curiosity you need to go revolutionize your own inventory. See you.
Welcome to this explainer. Today, we're taking a deep dive into the strategic blueprint of stock auditing. Whether you're dealing with a massive manufacturing plant, a sprawling retail chain, or a fast-paced e-commerce warehouse, inventory is usually the absolute largest asset a company holds. And yet, it's also the one that gives warehouse managers the most sleepless nights, right? So today, we're going way beyond those basic paper accounting sheets. We're going to explore the rigorous step-by-step procedures, the strict global standards, and the futuristic technologies that define modern inventory verification. Okay, let's dive right into this.
Here is how we're breaking this down today. First, we'll look at the silent balance sheet risk. Second, preparing the warehouse ground. Third, the actual execution of physical verification. Fourth, how to reconcile variances. Fifth, navigating those tricky, impracticable count situations. And finally, we'll look at the future of auditing.
All right, Section 1, the silent balance sheet risk. This is the hidden inventory gap. Let's kick things off with a bit of a reality check. You see, inventory discrepancies are these massive, silent risks just hiding on company balance sheets across literally every industry. It's not that companies lack tracking mechanisms, it's that they dangerously overestimate how accurate their underlying data actually is. The quote we're looking at here really hits the nail on the head. For decades, the annual inventory count has been this dreaded, totally disruptive day. It's a time when the whole warehouse basically turns into a chaotic maze of counting sheets and operations just completely freeze. But think about it, if you're only looking in that operational mirror once a year, you aren't really managing your inventory. You're just doing a post-mortem on the past 12 months of mistakes.
To really put a number on this problem, consider this stark reality. Manual inventory systems typically only achieve a 60 to 65% accuracy rate. That means over a third of your balance sheet asset could just be straight up misstated on any given day. Now compare that to environments that strictly enforce disciplined processes using RFID technology. Those setups can achieve upwards of 99% accuracy. So it's really the process lapses, not just a lack of technology, that create these massive hidden variances.
Moving on to Section 2, Preparing the Warehouse Ground. This is the pre-count blueprint. Because process is absolutely crucial, let's talk about the preparation phase. A successful, highly accurate audit requires building a rock-solid foundation before a single item is ever counted on the floor. Honestly, the prep phase is where the battle is actually won. Professional auditing teams follow a very strict blueprint. First, they clearly define the scope, which locations, what specific categories, and the exact cutoff date and time. Second, they have to understand the inventory flow. You have to fully map out how goods are procured, stored, and dispatched before you can even think about auditing them. Third, they review the systems and records, basically hunting for red flags like negative balances or strange manual overrides. And finally, and this is without a doubt the most critical operational step, they freeze inventory movement. You literally have to pause inward and outward movement, or at least implement airtight cutoff controls to freeze the data in time. Because if your stock is a moving target, well, your audit is pretty much doomed from the start.
Which brings us to Section 3, Execution of Physical Verification, putting boots on the floor.
So once the ground is perfectly prepped, we move to the physical execution. This is the moment of truth. It's where the pristine accounting records in the ERP system clash with the messy reality of the warehouse floor. Now, different environments demand totally different verification techniques. A full physical count is thorough but incredibly disruptive, usually reserved for smaller setups or absolute regulatory mandates. On the flip side, large dynamic operations rely heavily on cycle counting. This means continuously counting small, rotating subsets of inventory to maintain accuracy without shutting down the whole business. You also have sample-based checks for your high-value items and tech-assisted counts using barcode scanners or RFID. More often than not, auditors will actually use a hybrid of these strategies to ensure they are both efficient and completely compliant.
So the crucial point here is that physical verification is not just some nice-to-have internal best practice. It is a strict, globally mandated standard under ISA 501. If inventory is material to the financial statements, the auditor absolutely cannot just take management's word for it. No way. They are strictly required to evaluate the accounting instructions, physically observe the actual performance of the count, inspect the condition of the inventory for damage or obsolescence, and actually perform independent test counts going from the floor to the sheet and the sheet to the floor.
Next up, Section 4, Reconciliation of Variances. Time to explain those mismatches.
Now, what happens when the physical count inevitably, and I mean inevitably, does not perfectly match your ERP system? While finding a variance isn't the end of the audit, it's really just the beginning of the investigation. Variances aren't always just missing items. You might have location mismatches, where stock is sitting in aisle B instead of aisle A. You very often find unit of measurement errors, like someone logged a whole pallet of goods when the system was only tracking individual boxes. Or you see timing differences due to posting delays down at the receiving dock. The ultimate goal for the auditor here is to investigate these underlying process weaknesses and explain why they happened, not just report a mathematical variance on a spreadsheet and call it a day.
Moving to Section 5, Navigating Impracticable Count Situations. What happens when you just can't be there?
Let's introduce a major complication. In our modern, highly globalized world, supply chains are incredibly distributed. Sometimes, being physically present in a warehouse to count boxes is legitimately impossible. Which brings us to a really stark question. What happens when physical attendance is deemed genuinely impracticable? Perhaps the inventory is held in a location posing severe safety threats, or maybe a facility is entirely closed down due to unforeseen government mandates, exactly like we saw during the global pandemic. Now, what's really interesting here is how professional bodies heavily regulate this exception. ISA 501 does not let auditors off the hook easily. The standard explicitly states that general inconvenience or the cost of traveling out to some remote warehouse is never, and I mean never, a valid excuse to skip the count. The impracticability must be 100% genuine. When it is, auditors are required to perform highly specific alternative procedures to gather sufficient evidence without physically stepping foot in the room. So, if you can't be there, you must deploy strict fallback plans. Auditors might conduct a virtual stock take via live video, basically directing warehouse staff on camera to open boxes, move items around, and weigh things in real time.
If even that isn't possible, they rely on roll forward or roll backward procedures. Actually, scratch that. It's more like a painfully meticulous process of taking account from a different date and auditing every single intervening transaction to verify that year-end balance. They can also inspect subsequent sales documentation to prove the inventory existed or send formal ISA 505 requests to third-party warehouse managers to independently confirm custody. And if absolutely none of this provides sufficient evidence, the auditor is required to formally modify their audit opinion.
Finally, Section 6, the future of auditing. We are entering the era of tech-driven verification.
With all those stringent standards in mind, let's look forward to how technology is fundamentally rewriting these manual procedures as we move into 2026 and beyond. The entire overarching philosophy of inventory management is shifting, and it's shifting fast. We are moving away from the old paradigm of annual, disruptive, backward-looking stock counts. The future belongs entirely to continuous, preventative, real-time cycle counting. It completely transforms inventory control from this frantic end-of-year compliance task into a powerful operational tool that detects and fixes issues long before they snowball out of control.
And technology is absolutely the catalyst for this shift. To put that into perspective, by 2026, over 75% of enterprise organizations are expected to integrate AI-powered solutions right into their inventory operations. We're talking about computer vision technology, where advanced cameras continuously identify and count stock in real time with zero human intervention. We are even seeing automated drones instantly mapping out vast warehouses, executing physical counts that used to take teams of auditors entire weeks to complete. It's honestly incredible how fast this space is evolving.
So I want to leave you with this final, kind of provocative thought. Take a hard look at your own operations. Are you still treating stock audits as an annual nightmare that merely reflects the past year's mistakes? Or are you ready to embrace the modern blueprint, utilizing continuous cycle counts, rigorous controls, and AI integrations to actively shape your business's efficiency? The tools and the standards are already there. The choice of how you verify reality is entirely yours. Thanks so much for joining me on this explainer, and I really hope this empowers you to